Look at this first hour of trading. If you follow standard retail strategy, you sit down, wait for the opening bell, and draw a passive rectangular box strictly around the absolute highest and lowest wicks of the data. This is the classic initial balance methodology. The moment the price line breaks sharply above that top boundary, your platform flashes a breakout signal. You execute a buy order, assuming momentum is on your side. Instantly, the price stalls. It reverses direction, plummeting vertically straight back through the center of the box and crashing past the bottom boundary, hunting every stop loss along the way. The average trader calls this a fakeout or blames bad luck. The institutional reality is much colder. You are operating on a flawed tactical grid. When you build your strategy entirely on passive, historical price extremes, you position yourself as the primary target for algorithmic liquidity hunting. The mechanical failure of the initial balance comes down to its reliance on price wicks. High-frequency algorithms manufacture these extreme wicks specifically to trigger emotional reactions and harvest the stop losses of retail participants. By the time you execute an order based on these outer edges, you are entering the market at the precise moment large-scale institutional limit orders are stepping in to reverse the flow of capital. To stop being the target, you have to map the active internal volume distribution. This is the function of the DRW 20-40-50 matrix. Surviving intraday volatility requires abandoning static historical prices. You must read live institutional liquidity structures as they form. On the right side of this split screen, we are taking the exact same raw price data and removing the retail box. We replace it with a geometric bounding area representing total active session volume, building the institutional matrix. A distinct gold horizontal line locks perfectly into the vertical center. This is the 50% midline, the exact mathematical center of the active cash block. This line serves as the absolute structural bias filter for the current trading session. It represents true intraday fair value. The rule here is strictly binary. If price is trading above the midline, daytime execution algorithms maintain a strict bullish structural dominance. If it trades below, bearish control is established. Filtering setups through this 50% equilibrium anchor prevents fighting the dominant intraday macro direction. Next, we move away from the absolute extremes and look at the 40% edge lines. Thick, semi-transparent horizontal bands populate above and below the gold midline, occupying the 40% mathematical threshold of the internal range. Large institutions do not execute their massive capital at the outer wicks. They accumulate and distribute their positions inside these specific 40% boundaries. These walls represent dense clusters of resting limit order blocks waiting in the order book. Running earlier price action through this grid, price pushes up, but physically flattens upon colliding with the upper 40% limit band, unable to penetrate. This collision means the trend is slamming into millions of dollars of institutional defensive liquidity, resulting in a structural defeat of the upward momentum. Seeing these 40% limit walls shifts your role entirely. Instead of reacting to blind fakeouts, you are now anticipating deep institutional defense zones. The final layers of the consolidation cage are the 20% entry lines. These sharp, thin horizontal lines establish the extreme outer perimeter, flanking the thicker 40% bands. Breaching these gates terminates range absorption, crossing the threshold for directional escape. But a breach alone isn't enough. Notice the gray overlay. Price pierces the 20% gate, but stalls dead against the 40% wall inside it, mathematically invalidating the breakout. Valid institutional expansion operates differently. The cloud pullback. The UI shifts to a bright green status. Price breaks the 20% gate, dips to touch the precise top edge of the 40% limit wall, bounces upward and accelerates. This is professional entry. Distinguishing an engineered liquidity trap from a valid institutional continuation comes down entirely to observing how price interacts strictly against those 40% limit walls. Look at this overloaded interface. It represents structural failure caused by uncalibrated risk, reactionary fear-driven position sizing executed after an order is already live. Calculating your stop loss after you have entered a trade guarantees your decisions will be driven by emotion. The DRW risk unit equation is a proactive mathematical function designed to neutralize that psychological drag. The dashboard isolates a specific active equation. Live risk equals live range times 0.40. This framework codes your maximum allowable loss at exactly 40% of the live active structural range. During a high volatility state, as the structural range on screen vertically stretches and expands, the numerical output for the live risk value automatically increases in real time. Because the mathematical risk is wider, strict execution rules force you to scale down contract sizing to protect capital. Conversely, in a compression state, the session range compresses. The live risk value drops correspondingly, safely permitting scaled-up contract payloads with identical net dollar risk. Mathematically tethering your maximum risk to live session volatility before you ever click the mouse guarantees standardized exposure and complete execution certainty. This is the completed framework. You are looking at an active construction site of limit blocks, not a historical archive of WICKS. The tactical matrix continuously aligns the 50